Welcome to today's webinar on the Employee Retention Credit. I am Becky Komish, the Director of Operations at the New York Charter Schools Association. We're excited today to have several expert speakers on the ERC who can give schools an overview of this valuable tax incentive. We know that COVID and the craziness of the last few years has brought some uncertainty to operations and financial planning for your schools. With this presentation, we're hoping to provide school and finance leaders with some resources about the tax credit, which could result in some financial benefit for your campuses. Joining us today, we have three presenters. First, we have Ray Jacoby, who can wave. He might look small because we have the slides on the screen. Ray is an experienced partner at Mangel, Metzger and Barr, LLP, a regional accounting firm serving educational institutions in the state of New York from Buffalo to New York City. Ray specializes in working with charter schools, and he has hands-on experience with a variety of educational institution issues. Ray is also well-versed in the issues related to the Employee Retention Credit. Ray received his degree from the University of Notre Dame and is chair of the firm's assurance department and a leading member of the firm's technical review department. He is a member of the finance committee of the Alzheimer's Association of Finger Lakes and also a member of the American Institute of Certified Public Accountants and the New York State Society of Public Accountants. Presenting today from Alliant Group, we have Alliant Group's Managing Director, Brian Emuneller. Brian is off screen right now. Oh, I'm sorry, Brian, you're back. And I apologize if I said your last name wrong. I usually check. Can you say your last name correctly so people know who you are? I apologize about that. Oh, maybe you can't go on off of mute right now.
There we go. Yeah, Brian Emuneller. How are you?
Emuneller. Sorry about that, everybody.
We're good. I can't say it. It took me a long time.
Yeah, I've had interesting names my whole life, so I sympathize, and I
Listen,
do feel bad.
Just so you know, is for any reservation, I go by Oliver. So that's it. That's a true story.
So Brian has more than 20 years of experience providing consulting services to CPAs and their clients. Brian specializes in federal and state tax credits and incentives, managing CPA firm relationships, and helping CPA firms to identify qualified clients. Brian is a national practice leader with Alliant Group software, architecture and engineering, and contractor practices, and has worked with hundreds of small to mid-sized businesses in the area of research and development tax credits. And then joining Brian is Eric Heilton, who is Alliant Group's National Director of Compliance and former IRS Commissioner. Eric held several prominent positions at the IRS, including several as Deputy of Criminal Investigation Division and is CI's Head of International Operations. As National Director of Compliance, Eric employs his years of experience at the IRS to assist Alliant Group's clients as an ambassador for the U.S.'s small and medium-sized businesses and in helping others become tax compliant. So I'm going to turn it over to you guys to talk, just so that everyone in the audience knows. You can go ahead and put any questions that you have in the chat. We're leaving a bunch of time at the end so that you can ask your questions, but feel free to put them in the chat. Other people might have the same questions, so it's always nice to see them. All right, turning it over to you guys.
Okay, Becky, thanks. As Becky said, I'm Ray Jacoby, and I'm a partner with Mangel, Metzger Barr. Great to be speaking with you today. Really, my role here is just kind of set the tone, and then Brian and Eric are really going to explain to you a little more detail about what the ERC credit can mean for charter schools. It is, originally I think most folks thought, hey, you can only qualify this if you had a drop in revenue. But as Brian is going to explain, there's other ways to qualify that can be quite beneficial to charter schools. So I appreciate everybody joining today. You learned enough about me, and I just wanted to let you know Mangel, Metzger Barr. As you can read on the screen here, we really have devoted a lot of our time and effort to serving the charter industry all the way back to the early 2010s. We have a practice that serves approximately 70 charters right now, ranging geographically from New York City to Buffalo. And I've worked with the Alliant Group in the past on other tax credits, and I'm happy to be on the call today with them. And so I'll, at this point, pass it over to Brian to get into the kind of the meat of the presentation. So Brian, take it away.
Well, thanks, Ray. And hey, Ray and Eric, did you hear Becky say, did she say I had 40 years experience? I don't know. No, I need to know this because it's kind of, even though it's not accurate, it's kind of makes you take a step back. And And so I think, Ray, thanks for all of your support. For all of thank you, number one, for everyone here taking some time. Just know that I love moving through these presentations. This is not, we're going to probably get some questions at the end, and certainly interject along the way. Love it to be interactive, but we will keep this moving along, in the 15-20 minute span. And for those of you who are working with Ray and the firm already, thank you again. I've been on the phone so often with charter schools, and we're seeing so many opportunities to help. And so thank you, Ray, for setting this up. And again, I'm Brian Omuller. I'm going to talk to you about Eric in a second here, but we're a firm of about 1,500 people or so. We help small and mid-sized businesses. We work with CPA firms. We believe that everything we do has something to do with job creation, job retention, et cetera. All the credits and incentives, this employee retention credit being one of them. We have, for those of you in New York, if you see kind of dead center there, Rick Lazio, he's not here today, excuse me, but Rick is, many of you may have heard of him. He's a former congressman, very, very popular in upstate New York as well. We have him and Joe Crowley, who's from New York City. What we've done is we've assembled a group of people here. These are all employees. These are all people such as Eric here. I'll introduce more specifically, but these are all people that have a passion for small and mid-sized businesses. We have looked at the congressional intent of all these laws and opportunities, and also the spirit of it. If you look up top, you see Kathy Prochonchek and Dean Zerby. Specifically, Dean was a former U.S. counsel of the Senate Finance Committee. He worked through most of the tax legislation over the last 30 years. And so what we've done is been able to assemble a team, again, of strategic advisors. Employees are here every day. They answer emails, all that fun stuff. And Eric in particular, he joins, I got to tell you, this is a little scattered here slide. Right, Eric? This one's a new slide from marketing. But if you see Steve Miller on the right there, Kathy Prochonchek, who I mentioned up top, and then Eric, and we have Mark Everson, who is our vice chairman. We also have Eric Hilton, a former IRS commissioner. Eric, you've what, 30 years?
Yeah, 30 years. 30 years.
The IRS, and you came
30
up
great years there. 30 great years there, Brian.
I'm sure. And listen, we're love to have you here. And Eric joined us about a year ago, right? And just
Yes,
at the time, this employee retention credit was moving along. So there's going to be some good perspective here from Eric. So for those of you, I'm going to go through, this is tax law. We're not going to get all boring on the tax law piece here. We want to get to the exciting stuff. But long story short is the employee retention credit was part of the part of the COVID relief package, which everyone heard of PPP. And at the time, and again, I'm not going to read your bullet points here. I'm just going to go through this. At the time, when you claim PPP, you were not allowed to claim ERC. This is back in 20. So if your period of learning this, hearing about employee retention credit stopped at that time period in 2020, you would have heard, hey, I took PPP. Oh, I don't qualify for this. And it's a shame, but that's how it started out. But it changed, right? And basically what happened is the employee retention credit expanded, right? And I'm sorry, let me go back. It expanded and it increased the value here, right? And so in December. So basically what happens now is if you claim PPP, you can claim ERC. Very, very important distinction. There's no double dipping of the dollars, but there's always dollars remaining after PPP. And Ray, I don't want to put you on the spot because we don't know percentages, but right, if you claim PPP, what, 95% of companies have money left over, right? Would you say something like that?
Yeah, I mean, I would think that there's wages left over. It depends on what periods we're looking at. And you also can't double dip in any other federal funding. So all the title funding, you can't charge. Anything you charge the title funding, you can't charge and use for the employee retention credit either.
Yeah. But in our experience, right, we're always finding dollars left over. So right away, it's like, hey, this doesn't end the opportunity. Yes, do you have to consider PPP and the title things that Ray mentioned, but there's always money left over. So this is the important thing. This expanded, the other piece that expanded is in 2020, you had to have 100, in order to optimize the credit, you had to have 100 or less or fewer employees in 2020. In 21, they updated that to 500 and under. It doesn't mean if you're over 100, over 500 respectively, that you can't qualify, but it diminishes the value. If you're under 100 in 2020, but then under 521, you're potentially golden on this. Again, the purpose of that is to really say, look, there was an opportunity when you couldn't qualify for ERC, right? Because you claimed PPP. Then there was an opportunity to claim both, but you had to be under 100, right? And then it was diminished if you weren't under 100. Then they expanded it to 500. So over the last year, 2 years, they've continued to expand this and create more value for businesses. But why did they do that, right? So one thing that most of you heard. So the one thing is, if you claim PPP, we'll talk about some of these myths, you still have an opportunity for ERC. And two, if you did not have a revenue drop, that's significant. You had to have a 50% revenue drop in 2020 compared to 19, or a 20% revenue drop in 21 versus 2019. Most of you all did not have that. So, but the other thing out there was, hey, I didn't qualify. Well, there's another path. And this is the important thing moving out from the next 10 minutes. That path is that because there are 10,000 government orders at the federal, state, municipal, county, city level, 10,000 of them, that have created situations that you had to pivot and adapt and adjust. And your expenses even potentially went up. Not that they have to, but your revenue may have not gone down. And what happened? I mean, I can just tell you and we're gonna have some case studies in a minute, but I can just tell you things I've seen, right? Increased lunch periods had a higher staff, right? For social distancing guidelines, limited enrollments because of capacity guidelines. We even had a school, to be unnamed, but you may be on here, I don't know. We had a school that had to rent property and trailers, right? To create social distancing situations, obviously remote and virtual and getting internet up. So all those types of things. Why? That was caused by a government order. This is what you have to do in the state for this period of time. This is the path for you all. Did you have programs shut down? Or did you have after school programs? Did you have we even had another school in upstate New York that had, hockey games that had to be played in Pennsylvania, as an example. So all kinds of things, but it's caused by government mandates. So if you have missed payments and lower revenues or shorter hours or layoffs or net effect, those are all the things we can look at. And so, Eric, I know you've seen a lot of this across the country. Obviously, you guys, as you start reading these questions, plus we're all in charter schools, I'm pretty sure you're going to get 100% on this test. But I just want to, maybe you could walk through some of this, Eric, and what you've seen, because we talked about number one, I received PPP, but then you also have, we didn't see a 50% revenue drop or 20% revenue drop, but some of these other ones, right, that you've seen across the country, people in all businesses say, oh, well, I don't know that I qualify.
No, I mean, I appreciate that, Brian. I mean, so been with the Lion Group, as Brian said, about a year, after 30 years with the service and as commissioner of small business self-employed. And I mean, one of the things I really want to highlight is the fact Congress set aside $80 billion for this employee retention credit, which is, I mean, pretty, impactful for small and mid-sized businesses and across the board, nonprofits, private schools like this. But one of the things that when I retired, I wanted to kind of come out and dispel some of these myths that are here. And as we talk about a few of these, my business wasn't shut down. As Brian mentioned, having more of a, business modification or partial or full or partial shutdown. Yes, you can still qualify. Deemed essential. Yes, obviously there are certain businesses that were deemed essential, but that doesn't disqualify you from that. So I've seen quite a bit of that. You've seen businesses have grown to some degree as far as revenue is concerned. So that doesn't disqualify. Really, the essence of what we're looking at here is we look at all of these myths, all of them are false. And the essence is the fact that it is a facts and circumstances, qualifications that are associated with it. When I was with the service, we were thinking that approximately 70–80% of businesses would qualify for this because, hey, it's a once in a lifetime pandemic. And we really were trying to help, small and mid-sized businesses here.
But Eric, like, for example, you guys were planning for it at the IRS. That's why the timing was great for and thank you so much for joining us, which is, but what happened? You guys were all geared up for this onslaught, right? And then it was trickling in at
Right.
best, and then you realize why, right? And these are many of the reasons why it was trickling in.
Exactly.
Yeah. And Ray, I mean, you've seen this, you speak to businesses all day, every day. I mean, and myself included, I feel like, what do you guys think? I feel like 10-20% of businesses are claiming this, and whatever. I mean, I hate to use the adage 80-20, but what do you guys think? I mean, I'm finding, and it's always for a reason like this, right?
Yeah, I think the initial hesitancy was they didn't feel they qualified because they didn't have a drop in revenue. So that was really what everybody was hanging their hats on. And if they didn't have the drop in revenue, then they didn't think they qualified.
Look, I'm gonna step out on a limb here because it's in a presentation situation or a meeting situation. But I heard this last week, and I always try to pick up on things I hear to kind of intertwine them into my everyday. This person that said, Ray, just reminded me when you said this, person said to us, hey, there was a spotlight on the revenue drop, right? And that other one was in the shadows. And I actually said, I didn't know this person. So, and you guys meeting me for the first time, this is who I am. But I said to him, I said, well, what's interesting, sir? I said, there was no spotlight on the revenue drop. They were actually, it's equal. Congress created a situation that says you can have a revenue drop. And then they have a conversation that says, if you don't have a revenue drop, mind you, right? I mean, but you have a revenue drop or you have a business disruption. But you didn't have to have both. And so I said to him, I said, sir, those happen at the same time. It's the same law. And then you have to ask yourself, if the revenue drop was highlighted or the only case, why did Congress say, well, you can have a business disruption caused by mandate, right? There's a reason for that. And the reason is increased irritation, aggravation, frustration, expense, pivot, etc. Those are the things.
And I had plenty of conversation with congressional staffers on that very point that, yes, you have the revenue decrease or the business disruption, and they wanted to ensure that businesses took advantage of that business disruption piece as well. So,
yeah. So here's that, right? My business was not shut down. You hit on this, Eric. So here's, again, I don't want to read you all the bullet points. I'll give you some case studies. You'll get the flavor. But at the end of the day, these are the things we can look at. Again, tied to a mandate. So what we do, and I'll tell you at the end, but what we do is this is a research project. We have to find the mandate, the length of the mandate, how the mandate affected you, but that's on us. That's our heavy lift. But so these are the ones, right? Look at all these and think about the ones that, that come to mind. I mean, first one, you had a flat out disruption when you go virtual or remote. You had limited capacity. You had, you may or may not have mandates depending on where you are about sanitation, right? So those are some of the things we see. We know you can claim both. So this is one that's interesting. I just want to highlight this. We know it's different in sales, I mean, for you guys, but in that context, but at the end of the day, you can have increased revenue and still qualify, right? So I just want to be clear on that. It's, again, this is taking revenue off the table. Do not think of this in terms of revenue. Think of this in terms of impact, disruption, capacity, right? Shut down of programs, reduce programs, reduced hours, things like that. More people to accommodate social distancing and lunch periods, etc. So I promised we'd be at 20 minutes, 15, 20 minutes. I think we're going to honor this here, but here's some good stuff. So charter school, and look at these numbers. I want to pay attention. These numbers that we're going to give you are everyday numbers. Can you get $1 million? Sure, right? But can you get 186,000 with 30 employees? Yes. And these are from schools similar to you. Full shutdown of school, cancellation of after-school programs, capacity restrictions. No surprise there for you all on the phone, right? Here's a charter school, 29 people, right? And you look at, I mean, I'll highlight you the employee count, 219 in credits, and the reason why, right? Again, I want to be clear, this is all tied to mandates. So we have to look at the mandate. Here's a 997 employee school, 900,000 credits. So there's some of the things. Here's an 87-day school. And look, these are, again, you may wonder why, like here's 87, 277, but then here's 97, 907, and right, it doesn't seem like the ratios make sense. But it also depends on the towns and the cities and the states you're in, right? We have to go with the facts. And so those are the facts. So what happens is what we do. Guys, well, I'm hitting a fire drill, I guess.
Is this a good time to go to Q&A to let you mute for a minute,
Oh,
Brian?
you know what it is? I'm sorry. We got the Brooklyn subway suspect alert, as you all probably saw.
Oh,
God.
I thought, and I'm sorry, guys, for those of you who weren't on the call right before we started, literally 2 minutes, I'm at the Empire State Building. We had a fire drill, so the whole thing's going off. Now this is going off. It's crazy. But so what we have to do is we ultimately, do a study. We look at a financial snapshot. We look at the government orders, and we do an analysis. But that said, I know you may have questions, for Eric or Ray or myself, but feel free, anyone, fire away if you want.
just a reminder that for Q&A, people can feel free to put questions in the chat, or you can unmute yourselves and talk, because this is a real meeting style meeting where people can talk. It looks like, guys, there's one question in the chat right now, which is, what is the deadline to claim this ERC credit?
So good question. So I'm going to give you the practical answer and then the technical answer. The technical answer is you have 3 years from the day that you filed your original payroll tax return. However, not due to Eric and his colleagues, former colleagues, but the IRS is backed up right now. Okay. And so our point would be, if you have and want to pursue this, do it now. Get the study done, get the dollars in queue for refund. Otherwise it could take longer. Eric, we're seeing what, 6 to 9 months at this point?
Yes, exactly. Yeah, about that time.
You want to give your, actually, I heard this yesterday. Someone said, I didn't realize Biden's plan is he wants to increase it by 80,000 people or something like that.
Yeah, I mean, he's trying to have a significant amount, not 80,000.
I thought someone said 80,000. Well, 80,000, because the joke of it, this business owner says, I saw the program, they want to hire 80,000. He's like, I can't find a person.
Well,
I can't find one person. So good luck with that.
Right. I mean, so they're trying to hire 10 to 15 this year. We'll see. I mean, I think over a number of years, they're looking at about 80,000. But to try to help out with the processing, they've developed this surge team to kind of help out. So they have almost 2,000 individuals trying to really help with processing that. So hopefully that will cut down on that 6 to 9 month time frame. But yeah, over the last 10 years, they've lost a third of the workforce. So
yeah, I mean, and it's not real popular to go to run for office and say, hey, we wanted $1 billion right for the IRS. But guys, this is for, not to make a political statement, but the point is, and Ray sees this every day, the point is, just because the IRS gets money doesn't mean they're going to all of a sudden audit everybody that's out there. Maybe they can start answering phones and processing refunds and stuff. I mean, it's crazy.
Yeah.
So what other questions do we have?
So it looks like there's a couple more in the chat.
Okay,
I don't
look them
know.
up. I'm sorry,
Okay. Go ahead.
I didn't have it open because I had my.
Happy to read them if it's easier, or happy for you to do it. Up to you.
Yeah. Oh, thank you. I see that the bio does say 20 years, so no problem there, Becky. I just had to make that clear. No. So the other question is, will slides be made available? You guys are recording this, right, Becky?
We are recording it. Yes. And I answered that one in the chat. We are recording
no
this. We are going to post the slides and the recording to our resource center. And then everyone who's attending right now is going to get a follow-up email with a link showing you where you can access all that stuff.
Yep. Somebody asked something about fees. The answer is, when we work on tax returns, we always want to make sure we cap our fees, and it also depends on what the credits actually come out to. It's going to be different if you have 50,000 in credits or 5 million in credits. But I have my email address up there. Definitely, let's connect. And what we do is we want to give you at least a basic assessment. It usually takes like 5 minutes. I would do it personally, just so you know. And we would just understand a little bit more about number of employees, a little bit more about what you guys seen, where you're located, and then we can create a fee structure that would be appropriate. So actually, I'm going to put Ray on the spot here. Because I don't know, I'm not a PPP expert. Is the ERC available to schools who did not qualify for PPP? I would assume yes.
Yeah, it should be.
Okay. I just
If
know
you meet the other qualifications that you've talked about.
Yeah. Okay. Yeah. Someone asked, I presume this is not limited to charter schools, and that's exactly right. I mean, let's face it, charter schools, fantastic opportunity. But what we've seen, Eric, what comes to mind? I mean, we've seen manufacturing is
Right. Construction, churches. Yeah.
Churches. Nonprofits are good because look, the other thing we feel great about nonprofits is we work in a tax world, typically on income tax returns. And we know that in nonprofits, that's not an opportunity to save tax. This is one of the times that we could actually work with nonprofits. So lots of churches, charter schools, et cetera. But, manufacturing, construction are very, very strong. Distribution, auto dealerships is another
Right.
big, right? Anybody in the distribution that could have supply chain issues, right?
Any customer facing kind of organization that are out there, they made a lot of business modifications. So, spread the word, become ERC advocates out there.
Yeah, absolutely. Another question, I'm going to answer this question very directly, but I'm going to have multiple asterisks next to it, okay? The answer is, can you clarify the eligible reimbursement amounts formulas for 20 and 21? So the technical answer is very simple. In 20, you have up to $5,000 per employee for the year. In 21, you have up to $7,000 per employee per the first 3 quarters. All right, now, so it's the 21,000, right? 7 times 3, 7,000 times 3, 21,000 plus the 5,000, 26,000. So the answer is you have up to $26,000 per employee. However, these are the asterisks and the disclaimers. It's very rare that you're going to qualify for all employees, all quarters, and all 6 quarters. And here we go, we're all high-fiving. It's very rare to get that. You could do it, but it would be rare to do that. Okay, because we have to look, and just to give you the reason why behind that, we have to look at the mandates and when they were in effect. If they go in effect and we can qualify, they could go out of effect, and then back in effect, right? And it could be, there could be overlaid with towns and cities and counties and states. So those are all the things we have to look at where you're located.
Okay, yeah, it does.
I'm just trying to see. We had another. So, any fee-related questions? Again, we'll always figure out a way to cap it and look what the credits look like. There's another question on what quarters. Again, it's quarter 2, 3, and 4. Not again. I never said it. Quarter 2, 3, and 4 for 2020, and quarter 1, 2, and 3 for 21. That we can look at. So, and the other thing that you should understand too. Back to this slide, I'll put my back to this slide for questions on the study. This is not, if you had a revenue reduction, even though there's a lot of backup and support, it is a calculation to some extent. When you're and maybe Eric, you can touch on this too, but when you're in a situation where it's the government mandate, right? We're not just saying like, here's your number, right? We have to lay out the impact of COVID on the business, the impact of COVID on the industry, the impact of COVID on the geography or region, right? The impact of government mandates. We have to show this is a fact. Eric, you hit on it. It's a facts and circumstances situation. So we're not just laying out, oh, here's your number and here's a return. We have 150 pages of backup. We've got to go through the mandates. We got to lay out the mandates business impact. And then Eric, we have to show like what the law says is more than nominal, right? So
exactly
for that 10%. So we can't just say, hey, we had this one situation in the corner over here, right, for a week, and then we're all high-fiving because you qualify for $26,000 in person. We have to build this all out, right? And we have to defend it, right? I mean, we stand behind all of our work. We defend all of our work, and we want to lay it out on the front end how you qualify.
Yeah, I totally agree with that. I mean, providing that audit defense, I think, is critical because, at some point in time, the IRS will take a look at some of these particular, ERC credits that are claimed, and having that strong substantiation is critical and is important. And, I spent 30 years with the IRS, and when credits like this come about, you do have some fly-by-night organizations that will come and it will say, offer you, a certain percentage, but they don't provide the audit defense. They don't provide the level of substantiation or the quality. Here in the Lion Group, you have 4 former IRS commissioners that are here and ensuring that you have, a good quality product. And I think that's critical and maybe help you sleep at night as well.
Yeah, well, not, and also keep the dollars, right? Because our review, right, and our success in all credits and incentives is, and anything under audit is 94 cents on the dollar. So the point is we're keeping it, we're sustaining it, et cetera. And then Ray, we had a question that said the charter school fiscal years are usually July through June. So how do they have to account for their quarters when it comes to this?
Yeah, it would still be the, you know, your January to March being the first quarter, and then
Yeah,
Right.
April, June would be the second quarter.
yeah,
So in this case of 2021, which, you know, for most of the schools, all the schools actually, would have been last fiscal year. And then, you know, the last quarter that they would potentially be eligible for would be July to September of 2021.
mhm. What other questions do we have? We want to keep, we're about 33 minutes. But we're here for you as well. Any other questions that we can answer?
It looks like one came through in the chat, and I will just remind people that if you want to unmute and talk and ask your question live, you can go ahead and do that too.
Yeah, yeah, my email address is there. Shoot me an email, we can have a 5-minute call. The other question came in, Ray, about PPP grant, what were they eligible under this program? So the answer is there's no, your question is this, if we receive PPP, this will be the difference between what was received on the PPP grant and what was eligible under this program.
Yeah, so what you'd have to do is, let's assume, because the credit is calculated based on your qualified wages, up to $10,000 a quarter, and then you get a 70% credit. That's how Brian got to the $7,000 per quarter. So let's say in the one quarter that, you know, the school qualified during the entire quarter, and you had employee A who had $10,000 of wages, but when you look back, you had utilized you had tagged $5,000 of those wages to your PPP loan forgiveness. That would leave $5,000 for that employee for that quarter, that you would get 70% or $3,500 credit for that employee in that quarter. Is how that would work. You'd also have to back out the title funding if they were tagged to that as well, and leave with your net untagged wages that would qualify.
Any other questions? Okay, well, thank you so much. I know, Becky, you're going to wrap up too, but thank you everybody so much. Oh, I'm sorry.
I do have one. I was just trying to type it in when it talked about the title funding. Like with some charter schools, we just use the title funding for their salaries and not for benefits or taxes or anything else like that. So are you saying if that teacher was paid from title funding with just their gross wages, you cannot use that teacher with the employee retention credit? Even though it was just gross wages, not any taxes, not any benefits?
So I don't know, Brian, maybe you can answer. So I'm not sure about the benefits and such, if that's part of the equation here, or if it's just gross wages that are eligible to be.
Yeah, it's gross wages.
So
Right.
it's gross wages. Yeah. So if you tagged the, you know, again, teacher A's salary during a period of time to title, and that's the same period that you qualify for the ERC, you wouldn't be able to use those wages again.
Okay, thank you.
But one of the things that I think is important too is that as we go through it, see, these are all the intricacies that we do, right? And work with you guys to make sure that the credit's maximized, right? We're going to look at like the slide before here. It says bullet point 2, employee by employee analysis. This is what we do. So this is part of the process because we want to make sure we get you all the credits, you know, all the dollars you deserve, and make sure that everything's maximized appropriately. So, well, anyway, thank you again, everyone, for taking some time with us today. And Becky, I know you wanted to wrap up.
Sure. Although it looks like Digant shared one more question in the chat. It says, can you share a list of the government orders that schools in New York City were able to use to substantiate qualification?
Yeah, I have to say this the best politically correct way. We've had about 13 people for a year putting together these orders. We're the only database that has that. So that is one of the things. So the answer is we could certainly work with you to qualify you, but we wouldn't be able to share that list.
That makes sense. Okay, great. I'm happy to wrap it up. Everyone can see that Brian's email address is on screen, but in case you want a really quick copy and paste, I am putting it in the chat. Thank you to our presenters. Thank you, Ryan. Thank you. Thank you, Ray. Thank you, Brian. Thank you, Eric, for joining us today. We really appreciate you joining and sharing this info with our schools. We also appreciate everyone joining the webinar to watch it. We offer more of these topic-specific webinars. If you got here by referral and want to start receiving our emails, I am going to put a link in the chat where you can start getting emails about things like all of the webinars that we offer. We hope you can join us for some of those, including our statewide monthly charter school webinars, which are standing meetings on the second Tuesday of every month. They allow us to provide news and updates across the sector. The next one will be on May 10th at 4 p.m. And a link to register for that webinar is going in the chat. And that's a direct registration link. Thank you, everyone, for joining us. Have a great day.
Thanks. Have a good day, everyone. Thank you.
Thank you.
Bye.